This is a pain that will stay with me for the rest of my life.
Gary, your company is now bankrupt. Our economy is in a state of crisis.
Did you mislead your investors?
What we know now is Wall Street can bring down Main Street.
Interest rates are heading up, while savings rates are down. If you read the news, you're getting one message: panic. But an expert like Charlie Munger will tell you it's never time to panic. You just need a better strategy. A possible recession in 2024 doesn't worry somebody like Charlie Munger. He's seen every recession since the Great Depression. In that 100 years of experience, he's learned how to not only preserve wealth to ride out recessions, but grow during lean times, while everyone else is failing. His biggest piece of advice for hard times: roll with it. In a recent interview, Munger pointed out that there will always be tailwinds and headwinds in investing, meaning there will always be forces helping you and some pulling you down. One of those headwinds keeping you from growing as much as you'd like is inflation. During all of our lifetimes, inflation is going to keep rising overall, and the Fed is going to keep jostling interest rates to try to keep it from growing too fast. Those tweaks to interest rates and other actions by the Fed will sometimes damage stock prices. But Munger said the big money is not in the buying and selling, but in the waiting. Panicking because of the actions of the Fed can only hurt you. Be ready to roll with bad times because they will always come. A recession is a natural part of an adjusting capitalist economy. How do you roll with it? If you start with strong investment decisions, the best strategy is to wait things out. Consider the long term, not the short term. Charlie Munger says, "I'm pretty good at long-run expectations, but I don't think I'm good at short-term wobbles." He doesn't concern himself with what's going to happen next quarter. He's thinking about what's going to happen in the next 10 years. That's the mindset you need to thrive through a lifetime of recessions, not just a possible one in 2024. How does he do it? He recommends building up your ability to delay gratification. Don't try to turn a quick buck, especially during a recession. Avoid making decisions with only the short term in mind. Munger's preferred strategy can take decades to pay off, but that's how you get to be a billionaire. Extend your investment time horizon. Don't get excited about your gains today. Calmly await much bigger gains over the next decade. Here's one example of why this mindset pays off. During the start of the pandemic in 2020, a lot of people panicked. People pulled out their money because they saw the stock market plummeting. This was a bad move. Those who waited regained their losses after the pandemic. Those who made smart investment decisions during the drop even saw big gains. I even know people who panicked and pulled out their retirement savings early. They took a major tax hit. If they had been patient and waited just 2 years, they would have seen their portfolios keep rising in the long term. Don't act out of fear. Don't pull out just because you see prices dropping. You'll just cement your losses. If you bought a good stock with a good outlook for the long term, you don't need to worry about the dip of a recession. How do you tell if you bought a good stock? We'll talk about that in a bit. Remember, be patient and stay rational like Charlie Munger. Keep a long-term outlook. After all, being a millionaire in 10 years is better than making a few dollars now. It's definitely better than selling at the wrong time and losing a lot now. It seems so simple, but obviously most people can't do it. Why do people have such a hard time being patient and rational with their investment choices? Because most people respond to the media environment, and the media writes articles, like everybody else, to make money. Most news outlets get paid by their advertisers for every click they get on their article or video. This means to make more money, they need to write headlines that get clicked on. What motivates clicks? Fear and outrage. News outlets benefit from generating fear and outrage, meaning that if they can, they will always choose a more sensational take on a situation. This spurs a lot of people to make panic-based decisions, not choices based on rational thinking. If you can avoid the fear and stick with your plan, you will benefit heavily over someone who follows whatever scary news headline came out today. So the best thing to do in a recession is wait it out. But how do we know whether we've made good investments in the first place? If the entire stock market is going down, how do we know we're holding on to good bets? If you know a recession is coming, and a recession is always coming at some point in the future, it's an inevitable part of our economic system, then you must always make your investment choices based on a rational long-term outlook. So what does that really mean to behave rationally when investing? We already said you shouldn't make choices based on fear, but you shouldn't make choices based on short-term positive feelings either. Charlie Munger encourages you not to buy into fads. He considers something like cryptocurrency a bad investment. He even went as far to say it's not only stupid, but evil. Munger believes, on a larger scale, cryptocurrency undermines the security of our national currency system. For the individual investor, it's a bad call because it can drop to zero at any time. You have no way of knowing if you're making a good purchase because there is no way of determining which cryptocurrencies will have more longevity than the others. This means any crypto stock or crypto purchase will be very reactive to a recession. We'll see many of these crypto companies going bankrupt during 2024. So if you want to invest rationally during a recession, crypto is a bad choice, even if it has a lot of hype right now. Instead of making a fashionable, cool choice, pick stocks with staying power. Of course, no company will last forever. Like our physical world, every stock will eventually die. All our favorite brands will eventually go out of business. It's just the way of the world. However, there are ways to predict who will stick around the longest. Let's take a look at an example Charlie Munger likes to give: Coca-Cola versus Kodak. Coca-Cola is going strong after over a century. Kodak, which was founded at around the same time, failed and went bankrupt in 2012, surprising much of the international business community. Obviously, longevity is a good sign for a company, but it's not the only sign. Kodak was founded only 6 years after Coca-Cola, so they had been around about as long. They were both industry leaders in their niche too. Coke was the undisputed champion of soft drinks, and Kodak had similar mastery over film. So if they were both big names with market dominance who had been making money for over a century, what's the difference? Why did Coca-Cola survive, but Kodak went bankrupt and had to be solved? Because Kodak was pushed out by technological advancement. People still want to drink bubbly, sugary drinks, and that's not likely to change catastrophically in the future. But digital photography wrecked Kodak's whole industry, so a strong brand counts for a lot. But it can't save you if your entire product line goes obsolete. Coke would be in similar trouble if, say, a magic pill comes out that makes it so no one has to eat or drink anymore. Of course, this magic pill would also have to completely eradicate our craving for sugar. If that happens, Coca-Cola will be in trouble. But so long as people want tasty drinks, they're pretty much safe. When you are deciding on your investments, keep this comparison in mind. How adaptable is the company you are planning to purchase? Can their niche be rendered obsolete like Kodak? If their primary advantage is obsolete, do they have the infrastructure or other product lines to recover? For instance, drinking habits are trending toward healthier options in recent years. Many people think this will hurt Coca-Cola. However, Coca-Cola as a company has already diversified into the healthy drink market. They own Smart Water, Vitamin Water, Powerade, and offer many of their most popular drinks in low or no calorie form. Even if consumer tastes pivot completely away from sugary drinks, which I personally doubt, Coke is ready. Kodak didn't pivot their key competency as easily, so they failed. Besides considering a company's niche and offerings, how can you tell if a company is likely to ride out, or even do well in a recession? Look at their numbers for 2022. 2022 was not a great year. Did they make a profit in every quarter? Were they able to stay consistent with their income? Did they maintain a positive cash flow? If so, they likely have an advantage that makes them a smart choice for a recession. So now you know the best strategy for investing in a recession. Make your picks with longevity in mind, and take the time now to review your portfolio and dump anyone who didn't have consistently good performance in 2022. Don't cling to bad stocks because you feel like they should do well. Charlie Munger says the biggest factor in bad business decisions is denial. Don't waste time and money convincing yourself that the stylish Web3 stock is a really good pick, even though the company does nothing but lose money and float by on new investment. If they can't make a profit now, they probably won't survive a recession. Don't risk your money on them. Stick with long-term safe bets that are rationally a solid option. Avoid the quick shiny stocks even if all your friends are doing it. This is how Charlie Munger has become a billionaire in the last century. And it's how you can build a great portfolio over the next decade, recessions and all. Are you building your portfolio with retirement in mind? You don't have to wait 50 years to retire. You can do it in 10, even if you're starting from zero. Watch this video to find out.